Welcome to the calculations. We're going to be looking at the inventory valuation method. So the first one, according to our question, is going to be the first in, first out. So I'm just going to draw the table, but let me just read the question again. On the 1st of February 2020, a company in Innocentia had a balance of 10 units or 10 items at a unit cost of 85. Innocentia had the following transactions for the month of February. The purchases are given and the sales are given, but what we're given are different dates and different quantities, and we're given the unit cost. For the sales, we're given the selling price. Because we're doing inventory valuation, we have to disregard the prices. So just take note of the dates. They must be in sequence, and so the question requires you to do the following. Use the first in, first out method, use the LIFO method, use the AFCO method. Ascertain the number of inventory held on the 29th of February, the unit cost and the total cost of inventory. So in the end, you'll be required to draw the trading account. So we're going to start with our first in, first out. Starting with the first in, first out, you will draw a table. So I'm just going to say first in, first out here, and I'm going to draw three kind of main sections that I'm going to be using. The first one is I need my issues, and then I need my purchases, I need my issues, and I need the balance, and of course I need the date at the start here. I'm going to have a date, and then I'm going to say this is my purchases, or rather my receipts of the inventory. This is going to be my issues, and this is going to be my balance. I need a quantity, a price, and a value. I need a quantity, a price, and a value. I need a quantity, a price, and essentially a balance. So after having drawn this, I'm going to draw the other three lines that would help me. Right, I need to do this. Right, so we're gonna start. What's the starting thing? The company had an opening balance of 10 units. So we're gonna come here and say on the 1st of February the 1st, the company had a balance. So it's not under purchases, not under issues, but on the balance they had 10 units at $85. So this gives us 850. What happened next? What happened next was on the 2nd of February, they sold how many units? 7 units at 150. So if we are selling, this is first in, first out. First in, first out. So we're going to issue the inventory that we had first, and we'll always deal with this at cost. So what we're going to do is we are going to go under issues, and we're going to issue the inventory, which is 7 units. So if we're issuing 7 units, we're going to issue it at the price that we had it for, which is 85. Need a calculator. 7 by 85 would give us 595. So 595 is gone. And so what remains on February the 2nd? February the 2nd is going to be 10 take away 7, which is actually 3 units at $85. 3 multiplied by 85 would give you 255. 255 is our inventory on the 2nd of February. We just keep a line to make it. We move to the next date, which is February 3. On the 3rd of February, we purchased 15 units at 90. So this is buying. When we buy, we go under purchases. So we're going to record the purchases of the 15 units. So we purchased 15 units at 90. So we multiply 15 by 90 would give us 1350. So our balance is going to change. On the first we had 10 units, and then we sold 7, now we have 3, now we have plus 15, so we have 15 units at 90, which is 1350. So this is the inventory that we have on the 3rd of February. We have 18 units, but they come at different price. We're going to record them at the different prices, so keep the prices separate like that. Okay, let's move to the next transaction. The next transaction says on the 9th of February we sold 10 units at 155. So we're going to ignore the selling price. We're going to start with the date, February the 9th, and then we go under our issues. We issued how much? We issued 10 units. So the 10 units, we check our inventory. Do we have 10 units straight on the inventory that came in first? First in, first out? No, we do have 3. So we issue the first 3. So we're going to issue the 3 units at the 85. So this inventory of 255 is gone. And then we are short of 7 more units because we want to issue the 10 units. So we're going to issue 7 units at the next price, which is 90. So this would be your 630. So we have issued how many units? 10 units, which is what the date says. And what remains would be 15 minus 7. That would be 8 units at 90, which gives you a total inventory of 720 on the 9th of February, February the 9th. The next date would be the 12th of February. On the 12th of February, what happened? We actually purchased 25 units. So we're going to go to the purchases. So we go under purchases, and we first record the date, February 12th. We purchased 25 units at a price of 92. So we multiply 25 by 92, that would be $2,300. So our inventory is going to change. We had 8, so we are adding because we have received. So we have 25 at 92 plus the 8 at 90. So our inventory is now 2.3 plus the 720. So this is the total inventory on the 12th of February. And then we move to the next date. So when we buy, it's not really a problem. The next date would be on the 17th of February. On the 17th of February, we sold 15 units. So when we want to sell 15 units, we check our inventory. Can we issue 15 from the one first? They don't fit, so we just issue what we have. So we come under issues, and we're gonna issue the 8 units at the 90. So the 720 inventory is gone. We still have to issue 7 more to make 15. So 7, we're gonna issue the next price, which is 92. 7 multiplied by 92 would be 644. So we have issued our 15 units. Of the 25, we issued 7. So what remains, because the 8 is gone, the 25 take away 7 would be 18. So we remain with 18 units at 92. So 18 multiplied by 92 would be $1656. February 17. This is what was happening there. On the 18th of February, we purchased 20 units at 95. February 18, we purchased 20 units at what price? 20 units? 95. So 20 by 95, that would be 1.9. So our inventory is going to go up. We had 18, we purchased 20, so now we have a total of 38 units. So this is 20 units at 95, which is 1,900. So our inventory is actually 38 units on the 18th of February, and then we proceed to the next date. After the 18th of February, the next date would be the last transaction, which we sold 18 units at 165. But remember, this is our inventory valuation, so we are not regarding the selling price. We are going to record the date February 28, and we're going to go under the issues. How many units did we issue? We issued 18 units. So we are going to check, do we have 18 from the first? Yes, exactly, we do have. So we're going to issue the full 18 units at 92. So the inventory of 1656 is gone. So what would remain now are 20 units at 95, which gives us a total of 1,900. So this is actually our closing inventory. Our closing inventory is actually 20 units at 95, which gives us a total of 1.9. You can also add these totals to get the values here for the issues. 4,500. 4,500, that's the total there. And we also add this total. This total would give us 1,350 plus 1.9, 5,550 is our total purchases. So that's how you would do the first in, first out. Key things: issue the inventory that was earlier or that came in first. That's the key thing about this. Moving with our question, it requires us to calculate the inventory using the last in, first out. Last in, first out, different from first in, first out. So here we're going to issue inventory that came in last first. So you would see as we do our calculations. So we're going to start first with our balance. So on the 1st of February 1, there were 10 units at 85, so that gives us 850. The next day was on the 2nd of February, we sold 7 units. So February the 2nd we sold, so we go under issues, and then we're gonna issue the 7 because there's nothing that we can compare this against. We only have 85, so we're gonna issue at 85. So remember, 85 by 7 is 595. So the balance on the 2nd of February would be your 3 units at 85. 3 multiplied by 85 will be 255. 255. So this is our balance right at the 2nd of February. Moving to the 3rd of February, we purchased 15 units at 90. So February the 3rd, under purchases, we purchased 15 units at 90. 15 units at 90. 15 units at 90. 15 units at 90 would give us 1,350. If you do have the other calculations that you did, you would see that these figures are still the same for the purchases. This is last in, first out. When we buy, we're gonna say now we have, I can remove this. We have 3 units at 85. Now we have 15 units. 15 units at 90. And the value is now 1,350 plus the 255. So this is our inventory on the 3rd of February. The next date would be on the 9th of February. What happened on the 9th of February is that we sold 10. So this is where things start to be a little tricky. We sold 10 units. So February the 9th, we sold 10 units. So we're going to issue the 10. So we're going to go under issues and we're going to check. Remember, this is last in, first out. The inventory that came in last was this one. So we're going to issue from there. So we're going to issue 10. So we're going to say 10 has to go at the recent price, which is 90. So 900 worth of stock is going. And we're going to now say, okay, we do have a balance of 3 at 85, which is giving us 255. And then we took away 10 from the 15, so we now have a 5 at 85, which gives us 5 by 85, 425. 425 is the value of our closing inventory at the 9th of February. Moving to the next date, which is going to be the 12th of February. On the 12th of February, we purchased 25 at 95. So February 12, we purchased 25 units at 92. So 25 at 92. 25 by 92 would give us 2.3. So this is going to increase our inventory. So we go to the balance. We do have the 3 at 5, and we also have the 5 at 85. So now we have 25 more units at 92. And this is your 2.3. So this is all the inventory that we have on the 12th of February. Moving to the next date. The next date is the 17th of February. What happened? We issued 15 at 160. We're going to ignore the selling price. We're going to say we issued 15 units. So February 17, we're issuing 15 units. So we come under issues. This is last in, first out. So we're going to issue this inventory that came in last. We're going to issue 15 units from there. We do have stock. 15 at 92 is going to go. So this is 15 by 92. That's 1,308 of inventories going. So what do we have remaining? We have 3 at 85. And we do have 5 at 80. Is it at 85 again? Yes, at 85. Why are they different here? We had 15, we issued 10, so we remain with 5 at 90. This is supposed to be at 90. 5 by 90 is 450. And then we're going to have 5 at 90, and we do have the 25 take away the 15, that gives us 10 at 92. So this is the value of our inventory that we have. If you calculate the values you get, this is 255, and this is 450, and this is 920. That's the value of the inventory on the 17th of February. What's the next date? The next date is we purchased 20 units at 95. So February 18, we purchased 20 units at 95. So this multiplies 95 by 20, that's 1.9. And so our inventory is going to increase. We have 5, we have 3, 5, 10. Now we have 20 at the 95, which gives us the 1,900. So this is our inventory that we have at different prices on February the 18th. The next date would be the 28th of February, where we issued 18 units. So we're going to issue 18 units. We check our inventory. We do have 20 at 95. That's the last inventory that came in, last in, first out. So we're going to issue this first. So we're going to issue the whole 18 units from there. So 18 units must go out at 95. So 18 by 95 would be 17. 1710. And so 20 take away the 18 is 2 that remain here. So what remains now is 3 units at 85, we have 5 units at 90, and we have 10 units at 92, and we now have 20 take away 18, which is 2 units at 95. If I add the values of these inventories, they should give me 1,815. This is my closing inventory. If I add the units here, I'm gonna get 20 units. We always get the same units. We always get the 20 units for LIFO, for FIFO, for every method. The closing inventory is always the same. We should also get the amount that, let's just add, this is 5550. Adding that 595 plus 595 plus 900 plus 1380 plus 1710, that's 4585. That's the totals that we have there. So that's the last in, first out. What is there to note about the last in, first out? We issue inventory at the most recent price that we purchased it for. That's the key thing about this method. Using the average cost method now, things are going to be slightly different. This is the average, so we must get an average. The average is you add the opening and the closing, you divide by the number of units to get an average. So let's start. We're gonna start the same question. So it says on February 1st the company had a balance of 10 units at 85. So February the 1st, we straight away go to the balance, 10 units at 85, so that gives us 850. We move to the next date. The next date is going to be on the 2nd of February, where we sold 2 units. So we go under issues and we say February the 2nd, we are going to issue 7 units. So 7 units are going to be issued at the price that we have it for. Note, for the AFCO, the price only changes when we buy. So if we haven't purchased, the price is still the same and we only have one price. So this is what we issued. So if we issued that, then we have 10 take away 7, which is 3 units at 85. And this gives us a value of 3 multiplied by 85. 255, that's our value. And we move to the next date, which is on the 3rd of February. On the 3rd of February, we purchase 15 units. When we buy 15 units at 90, so we're going to record that February the 3rd. I'm just going to use different ink so that you can see the distinction due to not having lines. So February 3, we purchase 15 units. 15 units purchases at 90. That would be 15 by 90, 1350 here. Things are going to change. Things are going to change. We're going to get the average. The average of what? This amount and this amount, and the number of units. So let's just start with the number of units. The number of units is 3 plus the 15. So now we have 18 units. It's easier this way, and then you add the values of the inventory. We have 255 plus the 1350. So the value of the inventory that we have is actually 1605. So what is the price? The price is the value divided by the 18. So we divide this by 18 and we get 89.17 to the nearest. So this is the value that we have. So every time we buy, we average, and we only have one price. Unlike FIFO or LIFO, which is different prices, this one is only going to have one price. So the next date from the 3rd of February is the 9th of February, where we sold 10 units. This is going to be easy. So February the 9th, February the 9th, we issued 10 units. So we do have 18, so we can just issue the 10. So we issue the 10, and we issue at the price that we have it for, 89.17. So this is going to be 10 by 89.17. That would give us 891.70. And then we do the subtraction, 18 units selling 10. We remain with 8 at 89.17. So 89.17 multiplied by 8 would give us an inventory value of 713.36. We move to the next date. The next date after the 9th is going to be the 12th. On the 12th, we purchased 25 units at 92. So February the 12th, we purchased 25 units. We purchased 25 units at 92. So 25 by 92 is going to be 2.3. And so our balance is going to change, and our price is going to change as well. So coming to the 12th of February, we have 8 units plus the 25. So 25 plus 8. So we now have 33 units. The value is going to be the 713.36 plus the value that we purchased here, 2.3. So that would give us 3013.36. We need to find the average price. We're simply going to divide this by the 33. So our average price is now 91.33. That's the new average price. Every time we buy, the price is going to change. The 17th of February, February 17, what happened on the 17th of February? We sold 15 units. So we go under issues, and then we're gonna go 15 units going at the same price, 91.33. So we say multiply by 15 here, and we get 1369.71. So what do we have remaining? We have 33, take away the 15 that we sold. So we now have 18 units. 18 units at the 91.33. Things don't change. They only change when we buy. So this is 18 multiplied by 91.33. That would be 1.6. 1643.94. 18 purchased 20 units at 95. 20 units at 95. When we buy, things change. So 20 multiplied by 95, that would be 1,900. 1,900. So we now need to adjust the price. So we do have 18 plus the 20, so a total of 38 units. We don't know the new price, but we know that the value is going to be 1.9 plus the 1643.94. So the value for our inventory is going to be 3543.94. But the value is going to be divided by the number of units that we have, which is 93. So this is 93.26. Right. So this is our inventory on the 18th of February. Moving to the next date, which is the 28th of February, which is the last date, February 28th. February 28th. February 28, what happened there is that we sold 18 units. So we're going to sell 18 units. So we go under issues and we say 18, and we put the price that we have it for, which is 93.26. So 18 multiplied by 93.26, it will give us a value of 1678.68. And we're going to say we had 38 units, we sold 18 units. So this is going to have a balance of 13 minus 18, which is 20 units, at the same price, which is 93.26. We're going to just multiply that, 20 multiplied by 93.26. So this gives us our inventory value at the end of February, which is 1865.20. So essentially we have 20 units remaining at a price of 93.26, which is giving us a value of 1865.20. That is our closing inventory, and the value here, let me write it in black, is going to be 595 plus 891.70 plus 1369.71 plus 1678.68. That's going to be 4535.09. And the purchases is going to be 5,550. Nothing has changed on this side. So that's how you do your average cost method using the continuous weighted method. What you simply need to do is to be able to calculate your total cost of the inventory. So to get your total cost, what you're going to say is, what was your opening inventory? The cost of the opening inventory was 10 units, so 10 units multiplied by the 85, which was the price. So we do have 850, and you're going to add your purchases. So it's simply your opening inventory plus the total of your purchases. The total of your purchases, as we saw, was continuously the same. So this is the calculations that we did, and it was giving us 5,550. So if we add this up, we're going to find that this is going to give us 6,400. This is our total cost, but the total cost now has to be averaged because we want the average. So you need to find the average. The average would be your 6,400 as in the value of the inventory, and then we look at how much of the inventory did we have. So we purchased quite a number of inventories, and if you look at the total, we're going to see that we have 20 units of inventory that we dealt with, 70. So this is going to give us an average, 6,400 divided by the 70 would give us 91.43 to the nearest. So this becomes the inventory valuation using the weighted method. Simple as that. If you want to calculate your closing inventory, would therefore be, remember in all the calculations our closing inventory was 20 units. So we're going to take the 20 units, multiply with the average that we got here, 91.43. As you can see, this inventory valuation is going to be close to the other values of the inventories that we did, 18 to 8.57. That's the value of the inventory. So with this method, simply calculating the total cost of the inventories, you need your opening inventory, add all the purchases that you did at the different prices, and then you find the average. The average would be divided by the 70 units that we dealt with, and then you get that. To get your closing inventory, simply multiply the number of closing units that you have multiplied by the price. That's the average periodic method. It's different from the continuous method, because with the continuous method you need to be able to calculate the average as you go. This one you just calculate right at the end. That's why it's called periodic. The last segment or the section of things is that we were required to draw the trading accounts. You're supposed to draw them for each one of them. The first in, first out, last in, first out, average cost method using the continuous method, the average method using the periodic method. So I've just combined them to save time, but you can go through and calculate for each on a separate note. So when you're drawing the trading account, what do we need? We need to calculate our sales. Our sales is going to be the same for all the methods. So if we go to our information, we look at what we sold, and the prices are actually given there. Our sales, it was 7 units multiplied by the 150, 162. These are the sales that we did. So if we take our calculator and do the calculation here, we're going to see that our total sales is 7916. So it is indeed true for all of them. 7916, 7916, 7916, 7916. We're going to less the cost of sales. For us to get the cost of sales, we need the opening inventory. So we're going to say opening inventory. Remember, on the 1st of February our opening inventory was 10 units at 85, so our inventory is 850, and it is the same throughout. 850, 850 and 850. We're going to add our purchases. The purchases amount is going to be the same. Remember, under the receipts we received a total of 5550. It was true for all the calculations that we did. So the only difference in this table should be when we come to the closing inventory. So if we add up these things, 850 plus 5550, that's 6,400. 6,400, 6,400, 6,400, 6,400. What we're going to do is to less the closing inventory. This is where things are different now. The closing inventory for the first one, which is first in, first out, was 1.9. The one for our last in, first out method, we got 1815. The one for the average method, the continuous way, we got 18665.07. Okay, we're gonna differ slightly in terms of the average cost depending on how you round, but the examiner should have been strict when at least it's within a 1 rand or $1. The last method that we calculated our inventory, we got as 1828.60. So this is going to allow us to get our cost of sales. I'm just gonna write it here. 3331. Calculating 6.4, 1865.07. That's 4534.93. 7916. 3381.07. Last one be 6.4, take away 1828.60. 4571. 4571 0.40, take away that 7916, that would be equals to 3344.6. This side 7916, take away 4500, 3416. So these are the different profits that we have. So you can see that with first in, first out, you have a higher profit, followed by the average method, and then lastly we have the last in, first out. Just bear in mind that the last in, first out is not really examinable according to the International Accounting Standard number 2, but of course companies can use it for their own internal management purposes. So that's it. Thank you.